FedEx shares falling steeply after reporting its second quarter results after the close yesterday. FedEx lowered its revenue forecast for the year, no longer expecting flat sales, it says, but now looking for a low-level decline. Joining us right now for more on that report is Don Broughton. He is managing partner at Broughton Capital. And Don, this is a big decline for FedEx shares, down by almost 10%. Is what you heard from the company, does it warrant that decline in the shares?
I don't think so. I don't think so. Look, FedEx just produced a 25% increase in earnings per share on a 3% decline in revenue, which is far better than what UPS reported the previous quarter. UPS reported a almost 47% decline in earnings on a 10% decline in revenue. So they're faring far better. Plus, they didn't change full year guidance. I think that's important to note. And it's also important to note, Becky, you and I have talked about this over the years many times. FedEx is one of the most game stocks out there. It's seen as a bellwether for the global economy, the tech economy, the e-commerce economy, rightfully so. But it's moved literally. It was $140 a share last September. It's been as high as $280. Just 6 weeks ago, the shares were $225. So often we'll get people in there betting on what's going to happen. They're going to beat and raise. They're going to beat and raise, and then they do, and the stock falls back. So that's part of what's going on. The stock's just a little ahead of itself.
Not only that, I think what's going on here is it's a restructuring at the company. And Don, a lot of people look at this stock, as you mentioned, as a bellwether for the economy. What is this telling us about the broader economy? What is this telling us about the reorganization that they're doing there?
Well, if you look at the reorganization they're doing, they're making great progress. I mean, here's a company that is more than doubled its dividend in the last 3 years, and they are still have plenty of cash flow to aggressively repurchase shares. They just posted a better operating margin than UPS for the first time since UPS came public. They're doing a great job with what they can have. And what you have to have happen now is you need to have international air freight volumes really begin to pick up. And it looks like they're beginning to. November was a pretty good month. We saw Hong Kong volumes up 18% in November. So it's possible things are beginning to turn. And once they do, all that cost cutting could really power some really strong earnings to the bottom line.
Okay, what you're saying is really weird. If you're saying that numbers were up, an indication that the economy was much better globally in November, we've got all these people thinking the Fed's going to cut rates early next year because the economy's souring. So from your macroeconomic perspective, what you see in these numbers, does that pan out?
Yeah, no, it doesn't. And, we've got a whole group of people on Wall Street who are literally waiting for Godot. They keep waiting for the recession. And, air freight numbers have been weak, but they're really actually beginning to pick up in the last 2 months, suggesting things are starting to get better in that marketplace. And that's the problem for FedEx. The ground, they did extraordinarily well. In freight, they did extraordinarily well. Express is the laggard, but Express is 47% of their revenue. So, 1 percentage point of improvement in margin in Express is $1.30 a share in earnings.
So what's the problem with Express? Is that people are going other places for cheaper services? Is that people aren't willing to pay for quick delivery?
Well, there's a couple of things. One is onshoring is becoming a tidal wave. Literally, the U.S. is moving a massive amount of manufacturing, assembly back to our shores. And
that's actually good news overall, not for FedEx, maybe.
It is, but it just means less demand for international air freight.
Okay. I mean, that's an actual. These are huge macroeconomic trends that we can see through this. And if you say that we're actually moving a lot more of our sourcing here, I would say that's a good news for us overall as an economy, too.
If you look at what we're spending on building new manufacturing facilities in the United States, we have more than tripled that spending in the last 2 years. It is literally, you look at the chart, it's literally gone logarithmic.
Don, very quickly, what do you do with the stock? Do you buy it at these levels? What do you think is fair valuation? We're
buyers at these levels. It had gotten a little ahead of itself at 280 in the short term, But today's price looks like it's going to open at 250. This is a company that ought to be able to produce in the next 3 years, produce more than $30 a share in earnings. In the next 5 years, ought to be able to produce closer to $50 a share in earnings. I think that's worth more than $250 a share.